Hey, everybody. It is Jonathan Twombly with you live on Facebook. I am the owner of Two Bridges Asset Management, a multifamily syndication business that owns about 400 units in South Carolina. I'm also the host of the multifamily investment community and your host for today. And today we're going to be talking about how to structure a syndication deal. So I know this is a topic that a lot of people have a lot of interest in, and we're just going to jump right into it. So what to expect on this little webinar we've got here going today. Very high level discussion. Obviously, this is a huge topic. We could talk about it for hours. I'm happy to talk about it for hours, but I think that's a bit too long for a little video. So we're going to go into it at a very high level and give you the overview. Feel free to ask any questions you have at the end about either this topic or any other topic you have about multifamily investing. There is a feed going on, but there is a delay because I'm doing this with a screen share through Zoom. So what I will do is go in to the feed afterwards and answer all your questions. So you might want to hold them till the end and ask them then, because the way the feed works is a little wonky. So let's go, all right? So also something very special for you at the end. I am reopening my multifamily investment mentoring program called Multifamily Launchpad. This is a very special program. It only opens a couple times a year, and I'm going to show you how you can join if you'd like to. So stay tuned for that as well. So here we go. How to structure a syndication deal. Now, here's the basic problem that I find a lot of people have. People come to me with this all the time, and I see this posted in groups. I have a deal, but I don't have enough money to close. I also know some investors who have some money and they want in, but I don't understand who gets what in this arrangement. And I think people get even more confused when they want to put in a little bit of their own money and they're trying to figure out, like, how do I compensate myself for the work piece of it as opposed to the investment piece of it, what's appropriate. So I'm going to go through the really basic syndication structure, and I'm also going to show you what I do in my deals, which is a little bit, it's a kind of a variation on a theme. It's a little different from a standard syndication, but not terribly different. So the solution obviously is that you have to do a syndication. I want to make a disclaimer here, which is that we're not talking about the legal aspects of syndications. We're not going to talk about accredited investors and who can take part and when you can use, sophisticated investors and when it's not a syndication. You got to hire an SEC lawyer for that. We have some great ones in the group. Seek them out if you've got questions on this topic, but we're not talking about that today, okay? We're talking about how you split up the economics of the syndication itself, okay? That's what we're talking about today. That's what a lot of people have some kind of conceptual trouble with, is getting a handle on that. So just really briefly for review, what is a syndication, okay? A syndication is a deal where you have an active person who finds the deal, who's called the sponsor, and you have passive investors with money who cover the down payment and the costs. And just to preview something a little bit later, that active person who the sponsor can also be a passive investor in the deal. And that's, I think, an easy way to kind of get around that problem of, well, I'm putting in money, but then I'm supposed to get more because I'm doing the deal. And how do you structure that? Basically, you wind up with two hats on. Okay. And we'll talk about that later. Anytime you have passive investors in your deal, you're doing a syndication. Okay. And passive means that they don't have any right to control the deal. They're just hanging back and letting you do the work, right? They might have major decision rights, like if you sell something really, really major like that or refinance, but day to day, they have no control over what's going on in the deal. That makes them passive. That means you have a syndication. The number of investors you have, the amount of money involved, these are not relevant as long as someone is passive. You can have a syndication with one investor, and I actually have one of those. I have a single investor syndication for one of my deals. Okay, so the high level syndication overview is that the sponsor finds a deal, the investors contribute the money, the sponsor runs the deal for the life of the deal, the sponsor distributes the annual income from the deal, however they do that, whether it's monthly, quarterly, biannually, annually, however that's done. And then the sponsor oversees the sale at the end of the holding period, and the sponsor distributes the sale profits to the investors. So obviously very, very high level, okay? Now, how do you divide up the profits? Well, typically, here's what your investors are going to get, okay? They're going to get a preferred return, which is generally 8%. Now, what a preferred return is, in case you're not really clear on the concept, a preferred return means that they have a preference in the distribution of profits, right? That's where the word preferred comes. It's a preference. And what that means is they get basically first dibs. It means that before the sponsor gets paid, the investors are getting paid, okay? And there are basically two kinds of preferred returns. There is a cumulative preferred return and a non-cumulative preferred return. And the difference between the two of those is with a cumulative preferred return, you have to be at that preferred return average over the life of the deal to participate. So to make this more easily understood, let's say you have an 8% preferred return and 1 year you only make 7%. Well, obviously you don't participate as the sponsor that year because your investors didn't get their 8. But the next year you have to make 9. You have to pay them 9 before you can go to your split above the return. So that's what a cumulative preferred return is. And the further behind you get, that's when you hear somebody talking about getting behind a pref or behind a preferred return, what they're talking about is that situation in which they've been behind the pref for 1 or more years and they have to catch up and get back to an 8% average over the life of the deal before they can participate. And this can be very difficult if you get too far behind. A non-cumulative preferred return is just when the clock restarts each year. So even if you didn't pay them 8 last year, they got what they got. And this year, if you make the 8, then you get to participate above that. Okay. So that's the difference between the two. Now I say typically they're 8%. That's also kind of market dependent. Right now, it's pretty hard to hit an 8 because you've got, you've got very, very low cap rates that people are going in at. So even with leverage on the deal, it's hard to hit that 8. So preferred returns may be lower, right? They may be 7% or even 6, or they may be staggered. Maybe they're going to start out for the first couple of years at a 6 and then go back up to an 8. So, but typically, historically, they've been 8. That's been pretty standard. The next thing that investors get is they get a split or participation over the preference. So once the preference is paid, then there's some determination of who gets what above that. And I'll kind of go through a couple of examples of how that works. Then they're going to get the return of capital, and that can be a number of different ways. You could either pay the capital back going, from cash flow, or you can do it at the end. It depends on how you structure your deal documents, but it can be done either way. So either you're paying them a return on investment as you're going, and it doesn't touch the principal, or you're paying them a return of capital, a return of investment, and you're not paying them a return, so to speak, but the capital stock is getting lower and lower and lower. And then there's a share of the sale profits, okay, at the end. So just to review, they get preferred return, a split over the preferred return or a participation over the preferred return, return of capital, and then a share of profits. Now for the sponsor, what you get as a sponsor is you start with your split or participation over the preference, and then you get a share of the sale profits after the return of capital, after all expenses have been paid, and after any preferred return arrears are paid. So maybe you've gone, at the time of sale, you've gone 2 years without paying a preferred return. Typically, if it's a cumulative preferred return, you would have to pay those arrears out of the profit before you then went to your split with the investors to get your piece. Okay. Now, sponsor fees, there are lots of different fees that sponsors can charge. Most common one is an acquisition fee, which it happens one time. It happens at closing. It's usually calculated either as a percentage of the deal, so like the sale price, or as a percentage of the capital raised. It can be done either way. But this is just a one-time fee that you get paid for doing all the work up front. Oftentimes the sponsors put up the deposit on the deal and then they get paid back at closing, but they've taken the risk of not closing because they've fronted those costs. This compensates you for that. The next thing is an annual asset management fee. And this compensates you for the work that you're doing, overseeing the deal on an ongoing basis. So this is usually a percentage of either the revenue. So in the same way that the property management company gets, say 4% or 5% of the revenue, you might charge 1% of the revenue, or you can charge 1% of that initial capital raise. And the theory being that you are safeguarding that capital. That's your job. So you get a percentage of the capital as your compensation. There are also sponsors who will charge refinance fees on the theory that that is a lot of work to do a refinance. So they should get compensated for doing it. It's sort of extra work over and above the normal work. So they should get a percentage of that. And then there are also sponsors who charge a disposition fee or sale fee. So those are, two more fees that you might see in deals. Now the waterfall, how does the waterfall work? First of all, what is the waterfall? Well, the waterfall is kind of what I described before about, you've got a preference and a split and sort of how that works. So let me kind of walk through an example of how the waterfall works. So let's assume the following for this example. You've got $1 million capital raise. Your deal is generating $110,000 of annual profit. You're charging a 1% asset management fee based on the $1 million capital raise. You've got an 8% preferred return obligation, a 50-50 split over the preferred return, and then a 70-30 split to the investor on sale. And let's just assume that it's a $500,000 profit on sale, after everything, after all the costs are paid, broker's fees, you're adding back in your amortization. All of a sudden done, it's a $500,000 profit. Let's just, keep it simple. Okay. How's that going to work? So I made a mistake here. Actually, it's 120,000 of annual profit. That's a typo. So let's just assume 120,000. So $120,000 of annual profit. What are you going to get? So the sponsor is going to get $10,000 in asset management fees, which is that 1% of the $1 million, right? Then your investors are going to get their 80% preferred return, right? Now, just backing up to this point for a second, I just want to make a note here. This asset management fee, technically speaking, this isn't really coming at the profit level. This is an operating expense to the deal, but as a practical matter, you may not want to charge this either on your operating statement sort of until later, or also, it may be the case where you feel like, hey, if I'm not actually paying my investors the preferred return or not paying them anything, I shouldn't charge my management fee. But that's really up to you. You could contractually, you're entitled to get it, and you are doing the work. So I think there's a strong argument there that you should get it no matter what, as long as the deal has money to pay it. But that's something that you can decide sort of in the moment. But let's just say, so you're getting the 10K here, the investors are getting 80,000. And what happens to the last 30,000? Well, that's being divided in half, right? They're dividing, if you're going in that 50-50 split structure, they're each getting 15,000 of the remaining 30 of profit. So the final distribution numbers look like this. It's 25,000 to the sponsor, but that includes that $10,000 asset management fee, and $95,000 to the investors. So in this example, they'd be getting a 9.5% cash on cash return for this year. Okay. So, however, we talked about sort of the cumulative, non-cumulative distinction. Let's just see what happens if you don't make the pref, right? So let's say if the deal only makes $90,000, what happens? So the sponsor's still going to collect their $10,000 in asset management fee, and the investors are still going to get their $80,000 for their 8% preferred, but then there's no split, right? You've kind of exhausted, all the cash, right? So that's all that's going to happen that year. Now we get to the cumulative preference, and I'll show you how this works. So let's just say the deal only makes $80,000 in a given year, right? And you decide that you're going to take your $10,000 asset management fee because you're entitled to it. You did all that work, right? Overseeing this deal. The investors get their 70,000, which is short of the 8% preferred return that they're entitled to. So now you've got a $10,000 arrear, right? So that's my next bullet point. So you've got $10,000 in arrears now based on this 8% that you're supposed to pay them. So what happens? Next year, you need to pay them $90,000 or a 9% return to get back to par before you can participate in that 50-50 split over the preferred return, right? And if you miss it again, you only pay them $70,000. Now you're $20,000 behind the pref, and you've got to make that up in a further year. After that, you've got to get up now to, what is it? That's going to be $100,000 before you're going to be able to participate. And if you keep on going like that through the end of the deal, you may wind up having to pay them a big chunk of money out of the proceeds before you go to your split on the end. Now, most investors are going to prefer that you give them cumulative returns for obvious reasons, right? And I think it's also, frankly, it's easier to sell them the idea of a cumulative return because there's a little bit of pain for you, right? And the investors like to know that. They like to know that you're not going to just, if you have a bad year last year, it's like, oh, well, too bad for you guys. I'm going to get paid this year. I think they like to see that you're going to have to make it up to them before you can get paid. So just as a sales point, I think that's very helpful. Okay, so what happens on the sale of the asset? Well, the mortgage balance is paid. The sale costs are paid. Those are primarily broker's fees, some legal fees. Your investor capital is repaid, and then the preferred return arrears, if there are any, are paid. And finally, in this example, the profits are split according to that 70-30 split. So let's assume that there's $500,000 of pure profit after all the costs and after all the amortization and everything. The investors are going to get $350,000 of it, and you are going to get $150,000. This is assuming that there's no arrears, okay? Now, what if you put in your own money into the deal? How does that factor in? Well, it's actually pretty simple. Your money is just treated like any other investor's money, right? You don't have to worry about trying to figure out, like, on top of that money, like, what do I do? You just think of yourself as being in two different capacities. So you're going to wear two hats in this deal, right? One is as the investor, and that money is just like anybody else's money in the deal. You're getting a preferred return on your investment. You're treated just like anybody else, as if you were a passive investor, okay? And you are also the sponsor who's entitled to the sponsorship compensation, and that's completely separate. That's just a whole separate bucket, and the two just have nothing to do with one another, all right? Now, there are lots of different structures possible. Now, just as an aside here, when I first got into this business, I heard a lot about a structure where it was a 50-50 split. And, the idea was, you do all the work and the investors put up all the money and you split the profits 50-50 and everybody's happy. And when I went out and started pitching this deal to people, I got laughed at, to be honest with you. Maybe this will work with people who are kind of like legally considered sophisticated or legally considered accredited, but are actually not that sophisticated in kind of investing. Because what I found was dealing with very sophisticated, financially sophisticated people. They thought this was ridiculous, this idea. And I literally got laughed at, or people would tell me, I just don't think that's a fair split. Like, why should I put up 100% of the money and take 100% of the risk? And all you're doing is putting in sweat equity. And when you kind of looked into how these deals were structured on an institutional level, on a much higher level, they were structured very, very differently than that. So I quickly got over that initial idea and figured out kind of a professional way to structure deals. And so I'm going to show you what it is that we do. Now, I'm not saying this is the only way to do it. That preferred return 50-50 split is a very, very common, tried and true, completely acceptable way of doing things. So there's, that's a very easy and acceptable way to do things. So there's nothing wrong with that. But what I do is call the 1 in 20 deal. And this is based on a private equity model where it's a 1% asset management fee and 20% of the upside. Now, this is subject to a preferred return still. So what this means is, as I just said, it's 1% of the capital raised as an annual asset management fee, and then 20% participation as long as we hit the preferred return. So we have our preferred return, usually it's 8%. We always make it cumulative. After that, there's a 2% bucket for me. So assuming it's an 8% preferred return, it's always, like I said, an 80-20 split. So if the preferred return goes down, then my bucket goes down too. But typically it's 8% preferred return, 2% for me. And then everything over that 2% bucket is split 80-20 to the investors. Okay, so rather than preferred return 50-50, it's preferred return, sponsor bucket 80-20. And then on sale, we also do 80-20. We do an acquisition fee on purchase, but we don't do refinance fees. We don't do disposition fees. We just, we get compensated by that back end participation for all that other stuff. Now, let's just show you an example of how that waterfall would work with the numbers from the last go round. So let's assume that there's that $120,000 of annual profit. I would get my 10%, sorry, that should not be 10%, 1% asset management fee, so $10,000. The investors would then get their $80,000 or 8%. I would get a 2% bucket, so that's $20,000. And then the remaining 10 would be split 80-20 to the investors. So they get 8 and I get 2. So overall, that winds up with the investors getting $88,000 and I get $32,000, including the asset management fees. So you can see it's a little bit more favorable to me than that 50-50 split above the 8% preferred return. But then on the back end, I'm giving some back. So on the back end, if it's a $500,000 profit and an 80-20 split, they're getting $400,000 and I'm getting $100,000. And I figured out somewhere along the lines that, if you kind of model this out through the life of a deal, that including the asset management fees, I'm getting something like 23% of the deal, and the investors are getting about 77 or 78% of the deal, which people find is a perfectly fine and acceptable split. I've never had anybody complain about this at all. So obviously, that's a very high level kind of overview of how you structure a syndication. Happy to talk with you in the comments more about this, and after this, live show, you can always ask questions about it. But if you want to learn more about syndication, then this is a really, really great way to do it. My multifamily launchpad program, which I said is just about to launch. We do a lot of work on syndication, really go into the nitty gritty of it, kind of cover in great detail all of the stuff that we just can't cover in a forum like this. But in case you're wondering what Multifamily Launchpad is all about, it's an 11-week small group program. It covers everything that you need to know about real estate investing in multifamily real estate, from the basic question of where am I going to invest, what market is good, all the way to scaling a real estate business and everything in between. We really focus a lot on financial underwriting because I know that's a topic that causes people a lot of angst. We spend a lot of time in this to really build your confidence. We talk a lot about deal syndication and how this works. The whole program is designed so that to help you overcome the information overload that people are subject to because they've spent so much time researching and there's so much contradictory information out there. We just try to cut through it and just give you a roadmap and a step-by-step process to follow to make this just much more digestible and easy for you. It's also engineered to force you to take action so you get over that analysis paralysis once and for all. I'm just forcing you to do the things you need to do to get launched into the business through this program. And if you follow the steps, week by week that I have you do, you're going to be launched into this business when you're done. The whole thing overall is designed to build your confidence, make you feel like you really are an investor, get you moving, and just get you into business once and for all. So how do you get into the program? Well, there's a very, very brief application that you need to fill out, and we'll jump on the phone to talk about whether this is really a good fit for you or not. Because to be honest with you, I only take people I can really help into this program. I turn people down all the time. In the best possible way. Your money is not good enough to get into this program if I don't think that you're really going to benefit from it, because honestly, I can't look myself in the mirror and take your money if I don't think that this is really going to help you. So that interview is really designed for me to figure out whether I really can help you or not, and this is going to be a good use of your money. Have to act fast. We have an early bird 10% off discount that ends on Friday. If you want to get that discount, you must purchase by Friday. All sales end on the 29th. That's when the program closes. You cannot get in after that. The program itself is going to start on August 1st at 7 p.m. It's an online program. You don't need to be here in New York. It's all going to take place through video and through live chats with me where I answer all your questions. Extremely limited spots, and it is not going to open up again until October at the very earliest. So if you're eager to get started in your multifamily investment journey, now is the time to do it. Get into the program now. It's the summertime. There's not a lot going on. You've got time to really dig into it. Really, now is the best time to do it. So to schedule a call with me, this is the place to go. Just got a phone call in the middle of that. So this is the place you need to go. If you want to schedule a call, this is twobridges.leadpages.co/MFL. I will post this in the group so that everybody can see it. You don't need to try to copy it down now, although obviously you could do a screenshot if you want to and grab that URL right now. And as I said, I'll post comments in the live stream for this. So, well, we're not talking about getting your first deal. We can talk about getting your first deal if you want to, but we're really here to talk about syndications. So in the Q&A, post any topics that you want, and put them in the chat box and I will get to them. Now I'm going to do the technically difficult thing of trying to get into this live chat now so that I can answer your questions. So let me attempt to do that without screwing everything up. And I'm going to start getting to some of the questions that you guys have asked here. Okay, so here I am getting into the group. Just got to find the live feed. Here we go. Okay, excellent. I can see all your comments now. So here we go. Who's got questions? Okay, so John Bennett says, I'm not understanding the 2% bucket for me over the pref. So yeah, so this is, like I said, this is borrowed from private equity, and it is called, sometimes it's called a manager's catch-up. It's called, I prefer to call it a sponsor participation because the manager shouldn't really be catching up. There's nothing to catch up for. It's just a different way of splitting up these profits. So, it's just another bucket in the waterfall, really. Like I said, there are many, many ways to do this. That just plain split over the pref is very common. This is a very common private equity structure. It's how you structure a 1 in 20 deal. So that's really all I have to say about it. We could try to talk more about it offline if you want to, but I don't think there's really anything else to mention. But let me know. Any other questions? All right, so I am not presently seeing any further questions. So I'm going to give you guys a second to chime in here. And if you've got additional questions, let me know. Otherwise, you can always ask questions in this chat later on, and I will answer them. And you can always pose questions on this topic in the group. But I look forward to seeing all of you in the group. And as I said, if you're interested in Multifamily Launchpad, getting involved in that program, there are only 2 days left until Friday to get into to get the 10% discount. And if you want to join after the discount, you still have another week. So Jeffrey is saying, do I do personal mentoring? I do personal mentoring. You can find that on that page as well, the explanation as to what I do. There is a personal mentoring option. So I'm happy to discuss that with you offline as well, but that option definitely exists. So I'm going to post the URL in the comments, as I said, and you guys can go there, and the whole program is laid out for you, and you can fill out that application, which will take you no more than 5 minutes, and then we can jump on a call if it's something that you're interested in doing. So I really look forward to seeing all of you guys, and happy to answer your questions in the group. But I'm going to end this live chat now and jump into the group and see if I can answer any more questions. So take care, everybody.